What would happen if oil suddenly hit $200 a barrel overnight and stayed there? Not next year. Not after months of warnings. Overnight. By the time most people wake up, oil is trading at $200 a barrel. The gas station hasn't run out of fuel, trucks are still moving, planes are still taking off, factories are still running. But something has changed. Every company that depends on fuel now has a new calculation to make. And the first shock wouldn't necessarily be higher gasoline prices. It would begin with the systems most people never think about: transportation, shipping, food, manufacturing, and global trade. At first, businesses might absorb the extra cost. Then they start passing it on. But if $200 oil lasts for weeks, something more important begins to happen. People and companies start changing their behavior. And that's where the story gets complicated. Because the countries selling oil could suddenly make billions more, while the countries buying it start losing money. Governments would try to protect their economies, but every intervention comes with a trade-off. And if $200 oil lasts for months or years, the biggest changes may happen far away from the gas station. So the real question isn't simply what happens when oil reaches $200. It's this. What happens when the entire world starts planning for $200 oil to become normal? The first 24 hours would be strangely quiet. There wouldn't be empty gas stations or lines of abandoned cars. Most people would wake up, go to work, and see almost nothing different. The shock would begin somewhere less visible. Financial markets. Oil markets would immediately reprice futures contracts and expectations. Airlines, shipping companies, trucking firms, and manufacturers would start calculating what $200 crude means for their costs. And the first important distinction appears here. $200 oil does not mean $200 gasoline. The price of crude is only one part of what drivers pay at the pump. Taxes, refining, transportation, and retail margins all matter too. But crude oil is a major input, and markets don't wait for the supermarket or gas station to feel the full effect. Companies start planning before the higher costs actually arrive. An airline might hedge fuel, a trucking company might raise its rates, a manufacturer might delay an expansion. Nothing has collapsed yet, but across thousands of businesses, people are quietly making the same calculation. How long can we operate if this price doesn't come back down? By the end of the first week, the shock would begin leaving financial markets and entering the real economy. The trucks haven't stopped. The ships haven't stopped. But every trip is becoming harder to justify. A delivery company moving thousands of packages can't simply ignore a sharp rise in fuel costs. Airlines face the same problem with every flight. Shipping companies have to account for fuel across enormous distances. At first, many businesses would try to absorb the increase. That only works for so long. Eventually, higher operating costs begin appearing in freight rates, delivery charges, airline tickets, and the prices businesses pay to move raw materials. Then comes the part most people notice. Food. A carton of milk doesn't contain much oil, but getting it from a farm to a store can involve fuel, refrigeration, transportation, and petroleum-based packaging. One expensive input has now traveled through an entire chain. And suddenly, $200 oil isn't sitting on a trading screen anymore. It's showing up in household decisions. But the first week creates another problem, one that could eventually become more powerful than the original price shock. The strange thing about a sustained oil shock is what happens next. People start using less of it. Not because the world suddenly decides to abandon oil, but because $200 changes the calculation. A driver who used to make unnecessary trips may combine them. A A company may reduce business travel, a delivery fleet may optimize routes, airlines may reconsider flights that were already barely profitable. Individually, these changes look small. Across millions of people and thousands of companies, they begin adding up. And that creates a problem for the oil market itself. Higher prices can increase the value of every barrel sold, but they can also destroy some of the demand that made those barrels valuable. This is where the story starts to turn. Oil producers may initially earn far more money. But if consumers and businesses begin permanently changing their behavior, producers face a new question. How long can $200 oil survive if the world is actively learning how to need less of it? And governments now have another decision to make. Do they protect consumers from the shock, or allow the higher price to push people toward using less oil? This is where the $200 oil shock becomes a political and economic balancing act. Oil-producing countries could suddenly receive much more revenue from every barrel they export. Oil companies could see enormous increases in cash flow. But oil-importing countries face the opposite problem. They are sending more money overseas just to keep their economies moving. Governments would have several tools available. They could release strategic reserves, reduce fuel taxes, offer targeted support, or encourage people and businesses to conserve fuel. But every solution has a trade-off. Subsidizing fuel can protect households, but it also weakens the price signal telling people to use less. Releasing emergency reserves can calm markets temporarily, but reserves are finite. And pushing new oil production can increase supply, but major projects take time. So governments face a difficult choice. Protect people from $200 oil, or let the price force the economy to adapt. And there is an even bigger problem. If governments successfully shield consumers for too long, they may delay the very changes that could make the economy less dependent on oil. The attempt to soften the shock could end up making the dependence last longer. But governments can only delay the problem for so long. Eventually, companies have to decide what $200 oil means for the next 5 years, not just the next 5 days. The biggest changes wouldn't happen in the first day or even the first week. They would appear when businesses stop treating $200 oil as an emergency and start treating it as a permanent cost. 1 month in, companies would begin cutting costs more aggressively. Delivery fleets could optimize routes. Airlines could reconsider marginal flights. Manufacturers might look for ways to shorten supply chains and reduce how far raw materials travel. 6 months in, the decisions become larger. A company planning a new factory has to calculate transportation costs for years, not weeks. A logistics firm may accelerate investment in fuel-efficient or electric vehicles. Consumers may start thinking differently about the vehicles they buy. And then comes 1 year. By this point, $200 oil could be changing investment itself. Projects that once looked too expensive, alternative energy, electrification, local manufacturing, more efficient transportation, can suddenly become easier to justify. But the oil industry is responding too. High prices encourage producers to bring more supply to market, potentially putting downward pressure on prices. At the same time, those same high prices are encouraging customers to need less oil. The market is being pulled in opposite directions. And that creates the final question. If $200 oil changes the world's behavior, what happens when the world no longer behaves like it did when oil was cheap? At $200 a barrel, the most important changes wouldn't happen at the gas station. They would happen inside decisions. Which routes are still worth flying? Which factories are still worth operating? Which cars are still worth buying? Which energy projects are suddenly worth investing in? Because when a fundamental input becomes expensive enough, the economy doesn't simply pay more. It starts redesigning itself around the new price. Oil doesn't have to disappear to change the world. It only has to become expensive enough to make yesterday's decisions stop making sense. And that's the deeper consequence of $200 oil. Not that everything becomes more expensive, but that the world begins deciding what is no longer worth building, moving, driving, or powering with it. Stay there long enough, and it can quietly reshape the entire economy.